Good afternoon, Mr. Franca. How are you? Can you hear me, Fabio? Fabio, can you hear me? There's a mic icon, Fabio, at the bottom of your screen on the right-hand side that you would need to click. Nevertheless, we can maybe click and go live. Tommy, can you hear me?
Hey, Anton. Good to hear from
Hi,
you. I'm
Fabio.
good.
Thank you for joining us. Uh-oh, we've lost Tommy now. Well, we'll go live. There's two of us, and hopefully...
Hey.
Tommy, can you hear us now, buddy?
Yeah, I can. How are you?
Good, man. Not too bad. Yourself?
Yeah, good, thanks. How are you, Fabio?
Very good.
I'm good to me. How's things?
Yeah, good, thanks. Yeah, looking forward to Christmas now.
Same.
Jonathan, are you? Can you hear us, Jonathan?
Yeah, I can. Yeah, good to
Right. Let's do this, lads. Let's go live. Good afternoon, good morning, good evening, wherever you are. Thank you very much for joining us. This is Startup Fundraising Q&A. It's our 122nd session. We do this every Thursday from 12 to 1 p.m. UK time, where we seek to help startups like yourselves with whatever questions you may have on raising funds in order to take your business to the next stage. You see, the idea is quite simple. Unfortunately, over 90% of startups fail. And the top three reasons for that is 1, market fit, 2, running out of money, and 3, not having the right people. Now, when it comes to that second reason, i.e. running out of money, this is why we decided to do this, so that hopefully those of us who don't have a rich mommy or daddy or an auntie that leaves a fortune, or perhaps just a lucky sperm somewhere there, we may not be able to cough up the money ourselves. So we'll need to go and ask investors to do that, or a bank, or a crowdfunding, or whatever it may be. And that can be quite a maze in terms of navigating this world. Hence, if we get some help, I think it could be good. The idea is, if you're a founder in the room and you've got questions, whether on when's the right time to start fundraising, or perhaps deciding whether you should go to a bank or a VC or an angel or an accelerator or a corporate venture, or perhaps how to do your pitch deck, how to prepare for due diligence, and all that jazz, this is the place to be. I've got with us today 3 brilliant gentlemen that know the investment world inside out, and they're willing to spend the next 57 minutes with us and answer any questions we may have. The way we're going to do this is some quick introductions in terms of who we are and what we're doing here. And then on the other hand, we'll open it for questions from the audience. The sooner you put these questions in, the better it is, so that we don't then stay sort of till late waiting for questions. And then often the case, unfortunately, is that people leave it for last second, and then we don't have time. Simply, we run out of time. So that wouldn't be very nice. On the other hand, for those of you that are tuning in via YouTube or Facebook, please be aware that unfortunately we're unable to monitor your questions there. So you would need to join us live here on LinkedIn Live Audio. You can do that 2 ways, either by going to our website, startuptoscaleup.club, and click on today's session, which is Startup Fundraising Q&A 122, or you can simply just come to LinkedIn, search for Startup to Scale Up Club, and the last post there, it's the link to today's events, and you can do that way. Now, if your questions, by the way, today are not on fundraising, please save them for the other events we run. On Mondays, it's talent. On Tuesdays, it's product and tech. On Wednesdays, it's growth. And on Thursdays, it's fundraising. And they're all from 12 to 1 p.m. UK time. And you can RSVP to any of them via our website, startuptoscaleup.club. And a bit of good news, from January, we will add 2 more sessions. Those will be monthly, however. The second Friday of the month, we'll have a session on legal stuff, so you can query our lawyers on all things legal for startups. And on the third Friday of the month, we'll have one on finances, so your accounts, your taxing, and all that jazz. Now, some quick intros. My name's 𝗦𝘁𝗿𝗂. I'm an Albanian in London working with startups. Normally, right after they get investment, I embed within their teams and help them hire and keep the right people. I also do some growth advisory with a few other startups. And lately, I've been helping some angels and family offices with their due diligence and assessment. So now we'll perhaps start with Fabio, then Tommy, then Jonathan.
Hi everyone, Fabio Franca here, founder of 𝗬𝗏 Ventures. We are an early stage, an emerging manager investing in early stage startups in deep tech and the next generation of the internet. We also do some advising, and we are now looking into more permanent capital funding to fund deeper tech and more transformative innovation.
Thank you very much, Fabio. Yes.
Thanks, Anton. My name is Tommy Breen, and I'm a senior advisor at the Growth Stage. So we are a capital raising platform, as the name gives away, for growth stage businesses. So that means companies typically, looking to raise maybe their Series B or C rounds right up to much later stage pre-IPO rounds. And then I guess numerical terms, that's, companies looking to raise maybe $15 or $20 million, right up to much larger, into the hundreds of millions of dollars in some cases. And then outside of that, I'm also a mentor at Founder Institute, so working with and supporting earlier stage founders at the beginning of their journey.
Thank you very much, Tommy. Yes, Tom.
Yeah, I'm John, and I'm an early stage investor with Upside Down VC.
Thank you very much for that, gentlemen. Well, you heard the people. We've got 3 brilliant experts on fundraising and investment today, and they're going to be taking whatever questions you may have on fundraising for your business. There are no right or wrong questions, by the way, and there's no need to be shy. It's a learning curve for us all. All you have to do is raise your hand. We'll bring you up on stage, introduce yourself, and then fire away with your question. Also, just remember, if you are tuning in via YouTube or Facebook, unfortunately, we're unable to monitor your questions there. So you would need to join us live here on LinkedIn, and I'm going to post a link in the comments there, both on Facebook and YouTube, so that you can click that and join us straight here on LinkedIn. In the meantime, whilst we're waiting for some people to come up with questions, please do feel free to share this, by the way, or tag people that you think may benefit from joining us today. But perhaps our panelists may want to give us an idea on their biggest do's and don'ts when it comes to early stage raising. And by the way, gentlemen, don't worry about feeling like you may be repeating stuff from the past, because unfortunately, there are certain things that perhaps need to be repeated for founders out there. So maybe we can start in the same order that we joined. So Fabio, Tommy, and then Jonathan, please. There's a mic icon at the bottom of your screen, Fabio, on the right-hand side that you would need to click to be audible.
Sorry, Anton, I missed that. What was that again?
No, that's okay, buddy. What are your biggest do's and don'ts when it comes to early stage fundraising?
Sure. I think it's all in the preparation. There are certain things you have to do, to prepare. So your what we call your fundraising materials, your marketing materials. So well, make sure you have a registered business. I have seen some inverted commas entrepreneurs or founders, pitching an idea, and business was not even registered yet, which can be okay, but it's an open conversation at this stage. It's not necessarily pitching, but you need to have all your admin sorted, and also you need to have your pitch deck written. Something I don't see much, and I see in good founders is your business being described in, let's say, 50 words, and then 100 words and 150 words. It seems simple, but actually that exercise of synthesis actually forces you to actually really understand your business, what it does, and what you need, and what you're selling to customers. And it also helps on the in terms of having an elevator pitch. You know, if you're meeting an investor in a networking event or having a quick conversation, I mean, you're ready. You have your 100 words description ready. Having a website, having a logo, and most importantly, having a target list of investors you want to talk to, or you need to speak to, investors, VCs, whether they are VCs or angels, who actually invested in the same space as yours, or in a similar product, or who can give you access to customers. And you need to have that list ready, and then process with going through that list and meeting people on that list. And that takes a little bit of work, going on social media, going on LinkedIn, doing some research on what the investors are, who the investors are, and what they invest in. I think this would be the biggest do's, and the biggest don't is well, being evasive, not really knowing what your business does or who your customers are, being approximate, not knowing how much money you need to raise for your first round. But I think all of this results in a lack of preparation, really.
Thank you very much, Fabio. Tommy?
Yeah, I'd say something I've come across quite a bit in earlier stage founders is whenever it comes to the ask, you know, the amount of capital they want to raise, and when you drill into it and ask why, there doesn't seem in a lot of cases to be a lot of thought into it. It's more just driven purely by they want X valuation and they want to get this much money. So to be, you know, actually need to do your homework. Of course, there's a bit of, you know, art to this. You can't quite foresee exactly how much you need, and you know, at the early stages, nobody's expecting you to be the perfect well-rounded CEO and financial forecaster, but you do need to have some thought process into the reason you need the capital, how you're going to deploy it, and what that's going to do to accelerate your growth. So just thinking about that, you know, and it doesn't mean that you have to have loads of details in a slide in a pitch deck, but whenever you're pitching this and presenting it and you get asked questions, you need to have a clear thought out plan of, we're raising this amount of capital based on, you know, this research we've done. We think we need this much to get us through 12, 18, 24 months, whatever the runway is, and we're going to be able to deploy it into, you know, hiring, marketing, you know, building out the product. And, you know, we think that can translate into growing the business to this size and having, you know, this many subscribers and this much revenue, you know. So there needs to be a bit more detail in that in the background. It's something I've seen recently. So I'd say not just going out being like, oh, I want 500,000 or 1 million or whatever it is, because, you know, it seems like a nice number, a nice amount to have in the bank to give you runway, to just be a bit more thought out about that and be ready and prepared with those answers.
Thank you, Tommy. Jonathan? Jonathan, there's a mic icon at the bottom of your screen. Yeah, perfect.
Yeah, sorry, it just froze. I don't know. I think do come prepared. Don't fundraise for the sake of fundraising.
That's a good enough point. Thank you very much for that, Jonathan. Really appreciated, gentlemen. Right, so we now have 46 minutes to go. Hopefully we can go through quite a few questions, probably at least from 4 or 5 people. The idea is quite simple. We're here to help startups with whatever questions you may have whilst raising for your business in order to take it to the next stage. Whether those questions are about who you should try and fundraise from, how much, what are valuations, help with a pitch deck, perhaps due diligence, data rooms, and anything else in between or beyond for that matter. All you have to do is raise your hand. We'll bring you up on stage, introduce yourself, and then fire away with your question. Now, if your questions are not on fundraising, please save them for the other events that we do. On Mondays, it's talent, Tuesdays, product and tech, Wednesdays, growth, and Thursdays, fundraising. And they're all from 12 to 1 p.m. UK time. If you're tuning in via Facebook or YouTube, please be aware that you need to join us live here on LinkedIn Live Audio in order to for us to be able to hear you. I've sent a question that we received quite a while ago, but hopefully she will tune into the recording of this. So it's in the chat with the panelists. I don't know if you gentlemen have seen it. So she's a health tech founder at seed stage, used to be a doctor. She says, we've created a wearable device for continuous glucose monitoring. Our challenge is raising funds for hardware development, which requires more capital upfront than software solutions. How do I convince investors to back a hardware startup like ours, knowing it takes longer to scale? Is there any guidance, any tips you can give me? I guess we can start this from Fabio, then Jonathan, then Tommy, please.
So, sorry, to be clear, the question is how long it takes for business to scale? Is that the question?
No. So if you look in the chat, I'll put that question there. But it's
okay. Where is it?
How? So in our chat, in our messages, in the private messages, so she's created a wearable device to monitor glucose. And she says our challenge is raising funds for hardware development.
Got it. Yeah, got it. Thank you, Anton. Hardware is not the most popular market product that investors VCs go for, mainly because of scaling. It's complicated, in terms of supply chains. I mean, we looked at hardware, and it takes longer because, well, it doesn't have the potentially the J-curve effect that VCs are looking for. VCs are looking for a multiple on exit. So she needs to approach VCs, investors who actually invest in hardware, or partnering potentially with some suppliers and some companies who are building both software and hardware. So it's a different animal. We don't do that, but you have to really demonstrate, your supply chains, how you extract value, how you manage your margins. Obviously during COVID, there was a massive reliance on China, and in terms of semiconductors, you rely on Taiwan. So you need to demonstrate that you can actually mitigate all those risks, and it's a little bit harder. But if you do have a good product, and then you can demonstrate that this product is potentially being bought already by some of your customers, then it makes things a little bit easier. I think that's what I can share today.
Thank you very much for that, Fabio. Jonathan, I don't know if you got a chance to read the question.
Yeah, for me, it's about getting if we were talking about the convincing for the high capex startup, I think you got to find VCs and angels with that kind of thesis. I think you don't want to try to have to convince an investor to put money into something like this, because I don't like the idea of convince such and such. I think it's it's got to be more there's a certain amount of you don't want to get it to an overly forcey kind of pushy kind of state. So definitely find people that are interested in this sort of thing first. That's what I'm saying by it.
Fair enough. That's a good enough point. Tommy, what would you do
I agree
in this case?
I agree with what Jonathan's just said there, and Fabio too. This stuff is hard. Hardware has always been difficult to raise capital for because it's got a longer journey usually to come to market, and the failure rate is a little less, maybe not less predictable, but definitely higher. There's a lot of risk, and it's a bit more binary as well than software. Typically you're a zero or you're a winner. But what Jonathan said, you need to find the people, the investors that invest into med tech hardware. So you need to do research. You need to go on Crunchbase, see the insights, all these platforms, PitchBook, look at other med tech device companies, see who's been investing in them, this particular product without, you know, having the founder here to tell us more. You know, glucose monitoring, you know, there's quite a lot of these in the market now. I always see them in my Instagram feed, people advertising and marketing these. So, you know, maybe try and look up who some of these other competitors in the market that exist have gotten funding from. And, you know, potentially there is grant opportunities for this as well, if the glucose monitoring is going to be targeted at, you know, diabetics and helping them manage their diabetes. But, you know, it's always going to be difficult. You need to find the medtech hardware investors. But just this specific product, you know, I do get the impression, I don't know well, but I get the impression it's a pretty crowded market. Like, I have lots of friends that aren't diabetics and have used glucose monitors just to try and understand, you know, what spikes their sugar levels, things like that already, as well as having a brother who's diabetic and already has these monitors. So, you know, it doesn't sound, unless, and maybe they've got some innovation in there without having them here to tell us more, it also sounds like they're trying to raise capital to start a business that's going into a crowded market. So unless they can really demonstrate something unique in their hardware and their tech that's going to set them apart, even the investors that like to invest in medtech hardware, you're going to find it probably pretty difficult. So I'd keep that in mind as well.
That's brilliant stuff. Thank you very much from all three of you. The only thing I would add to this brilliant stuff, and this kind of goes in line with what the gentlemen have said, is you might want to look at angels who've exited similar businesses in the last few years. They tend to have the money. They definitely have a better know-how of the market and, you know, some of the problems or challenges you may encounter. And I think Tommy mentioned Crunchbase. From what I can see, you're based in London, so maybe look at going to the City of London Small Business Research. You can actually get access for free to platforms like 𝗏𝗏 and a few others. So there you can do that research for free. But I would also look at things like Innovate UK, NHS Innovation, and also some universities, especially university college hospitals, in order to, first and foremost, because you said, you know, you need money for product development. So I'm guessing you haven't started building anything yet. So that's what I would definitely look at first. Have a look at some accelerators as well, just to make sure, as Tommy touched on, you know, you standing out from the crowd, basically. You want to be talking to people that are going to pay money for this. So you want to have as many conversations beforehand, making sure that what you're building, there is some innovation there, that it's good enough to disrupt the market, basically. Otherwise, you don't stand a chance. So I would definitely focus on this if I were you. Right here. I guess a quick reset of the conversation. This is Startup Fundraising Q&A. It's our 122nd session. We've been doing these now for over 3.5 years, and we've had about 270,000 people that tuned in. We've now moved from Clubhouse to LinkedIn, and I think we need all the help we can get to spread the word. So please do feel free to tag anybody you think may benefit from this, or just share this session. Would really appreciate that. But if you do have any questions on how to go about fundraising for your business, then you definitely want to raise your hand. We'll bring you up on stage, introduce yourself, and then fire away with your questions. If your questions today are not on fundraising, please save them for the other sessions we run. On Mondays, it's talent, Tuesdays, product and tech, Wednesdays, growth, and Thursdays, it's fundraising. They're all from 12 to 1 p.m. UK time. Now, we're also, by the way, going to soon, from January, we're going to add 2 more sessions, although they'll be monthly. Second Friday of each month, we'll have a session on legal stuff, and that is UK-centric. And then on the third Friday of every month, we'll have a session on finances, so accounting, taxing, all that jazz. And again, there'll be Fridays 12 to 1 p.m. UK time. And if you want to RSVP to any future sessions, i.e. next week will be our last week for this year, you can do that via our website, startuptoscaleup.club. I'll put another question in the chat for my panelists if you've had a chance to read it, gentlemen, but I'll read it out loud for our audience. Now, this is another London founder. They're in fintech, a former banker, and he says, I'm building a financial management platform for Gen Z. With so many fintech products on the market, how do I position mine as unique when pitching to early stage VCs? And what traction is most important for investors at this stage? Okay, I'm going to try and be kind. If you don't know how you stand out from all the others in this field, how on earth are we meant to do that, or an investor? And especially if you're not here to ask the question. That's one. In terms of traction, look, it really comes down to money and how many people are willing to do that. Unless, of course, you are a successfully exited founder and you can show that you've had a few businesses under your belt, then that's a different story. But let's hear it from the panelists here. So perhaps this time we can start with Jonathan, then Tommy, then Fabio, please.
Sorry, so what's the question again?
So it's in the in our chat, Jonathan, and it's, where's the guy? Yeah, fintech founder in London, pre-seed. He's a former banker, and then he says, "I'm building a financial management platform for Gen Z. With so many fintech products on the market, how do I position mine as unique when pitching to early stage VCs? And what traction is most important for investors at this stage?"
Yeah, sorry, the LinkedIn Live app is very clunky, but to answer that question, I think it's the wrong questions to be asking. I think you're 100% right. I think it's far more important to ask, like, first off, you got to know like why you're building what you're building. So it sounds like you don't know what the reason why you're building what you're building. So that's far more important than why investors should care about what you're building. And it seems like you care about the opinions of investors too much. Like, we're not God, and and in the end of the day, like, you're here to build a business because you have a unique insight on like how the world can be like 10x better in like the manner that you selected. So I think you need to deep down figure out why you're working on what you're working on. And then as long as like lots and lots and lots of people agree with you and are willing to tag along with you this journey and then purchase what you are building or you're hoping to build, then I think those are far better questions to be asking.
Thank you very much, Jonathan. Tommy.
Yeah, just I gotta continue on from what Jonathan said because I agree with all of that. So I'll just talk more on the traction. When you ask what traction is important for investors, I guess the question back is, what traction do you have? Do you have, do you actually have an active product with people using it? Are they using it for free? Are they paying for it? Or are you at the stage where you're got an idea to build, but if you've an idea, you still need to show traction. So you need to build a landing page, have a marketing funnel, whether you're advertising on TikTok or Instagram or YouTube, whatever it is, and showing that you can use either organic content or paid marketing, but you can actually build a funnel where you can get views, get clicks, get people coming on the landing page, and then are you on the landing page collecting emails, so people registering interest when the product's live. If you're going to do it all organic, it doesn't cost very much. You can pay somebody probably 200 or 300 quid on Fiverr to do the landing page for you if you can't do it yourself. If you want to do paid marketing, I'm sure for £1,000, £2,000, you could at least start to get some inclination of how it might work, and at least then you can show there's interest in the product. But in terms of what the USP is, what you're doing, that's down to the founder to put that into the marketing content and the organic content they put out and whatever their channels are and put it out and see if they actually get people signing up and coming down the funnel. So I'd say to really focus in on those things.
Thank you, Tommy. Fabio?
Yeah, no, I agree with everything the guy said. I think I would like to bring attention to the Gen Z part. It seems it's quite important for the founder. I mean, Gen Zs, of course, we can talk about traction and the different metrics, and we all know those metrics, and they should know those metrics by now, as you said. Whether the app is sticky or what is the number of users and so forth. I think it's pretty more around explaining why, or explaining what community, what is the community that the product will bring. I think Gen Zs don't want another app. I think to market as an app is not as exciting for Gen Zs. I think they want a movement. They want, and we saw that with crypto. We saw that with the metaverse story and the meme and the meme coin cycle that just started. It's all about communities and how people identify with other people out there. So will that product bring people together because it's so good, or there is such a unique feature? And if it's so unique and it brings people together, I mean, the founder may not even have to really explain why there is such traction. I mean, he can explain why, and there would be all sort of sociological factors and psychological factors. I mean, explain a meme, for example, it's hard. So what will this app, this fintech app will do, and why it must exist? I think it's very much the answer they need to. This is very much a question they need to answer, and that the only answer is by showing how the community gets together, why they use an app, and it's almost like I think it should redefine financial freedom, which is the key theme for Gen Zs these days. I mean, this is my 2 cents.
Thank you very much for that, Fabio. And if I may add just one more thing to that, I think the gents on the panel might be sick of hearing that from me, but there's something I call 𝗦𝘁்𝗿. So, and I've seen this work well for startups. N stands for needs. So you've got to think, what is the need that you're fulfilling here? Or what is the problem that you're solving? W stands for want. You've got to be really clear and go extremely niche on who's going to want this and who's going to pay for it. I stands for innovation. What is the innovation that you're bringing to the fore? D stands for disruption. Who are you going to disrupt out there? Basically, who are you going to need to steal clients from for this to be a success? And probably just as important as the first one, that need, that problem solving, S, which stands for scalability. And this is where investors then get excited, I guess, more, is how is this scalable? How much money are you going to make for you and for them? And what is it you have and don't have for this? If you can find a way to elaborate that properly, then you have a better chance at raising investment. Hell, you've got a better chance at succeeding. But again, it looks like you're quite early anyway, so I would definitely not even think about VCs at this stage. Unless VCs that trust you and they're willing to give you that money, then that's a different story. But that normally is not the case at this stage. So perhaps what you want to do now is, I think Tommy touched on the landing page part, but not just that. You just want to go out there, build it first, get some traction, and then you can see where that takes you. Right here, we've got Regina on stage. Welcome back to our stage, Regina. Please introduce yourself and fire away with whatever fundraising question you have for us today.
Yes, my name is Gina King, and I primarily build things in the cybersecurity space. I've been on here a couple of times. I love this group. I actually wanted to respond to the question that the gentleman posed, where he is wanting to know, basically why he should do what he wants to do, or saying he wants to do. And I just wanted to make a comment, because I think sometimes we assume that people can make that connection. But I wanted to share the reason that everyone is saying that that's the question you need to answer is because at some point when you're talking to investors, or even when you're talking to potential clients or people you want to hire, they're going to ask you some questions that make it seem like your invention should not exist. And what will you say? What will be that core reason or that story or that something that you can bring to the forefront? So I don't know how you're picking Gen Z, how you're picking this particular industry or any of, like, none of that was shared. And those are the things that you want to figure out. And not only for that gentleman, for anybody, why do you think your thing should exist? Like, what's that story? What's the problem you're solving? And so that's what I want to share. Because sometimes when I'm talking to people and I'm trying to help them with whatever they're doing, they think is a good idea, but they don't have the reason why. And they've spent so much money, so much time, and built this whole thing out. And then we realize it's not even a viable product. Nobody is going to use it. And it's very sad to watch. So I just wanted to share that information.
Good point there, Gina. Thank you very much for that. Okay, quick reset of the room then, I guess. This is Startup Fundraising Q&A. We do this every Thursday from 12 to 1 p.m. UK time, where we seek to help startups with whatever questions you may have on fundraising, whether you want to know when's the right time to fundraise, who you should try and raise from. Maybe you want to learn more and gain clarity on valuations, on pitch decks, on due diligence and data rooms, and anything and everything else in between or beyond. This is your chance to get answers that will work for you. We've got three brilliant panelists on stage with us today, and they're going to be here now for the next 23 minutes. So if you've got any such questions, please raise your hand. We'll bring you up on stage, introduce yourself, and then fire away with your question. On the other hand, if your questions today are not on fundraising, please save them for the other conversations we run. And by the way, panel, I'll put another question from somebody in London about fintech, which we can take in a second if we don't have any live ones. So if your questions today are not on fundraising, the other rooms we do, it's Monday's talent, Tuesday's product and tech, Wednesday's growth, and obviously, as you can see today, Thursday's fundraising. You can RSVP to that, to any future rooms via startuptoscaleup.club. Now we can go with another question, and again, this is on fintech. So this is a fintech founder in London, seed stage, ex-financial analyst, and she goes on to say, I've built a B2B payments platform to simplify cross-border payments for SMEs. I'm currently raising 2 million. How do I assess whether to raise from a VC, CVC, or pursue an equity crowdfunding campaign? And what trade-offs should I consider with each? That's actually quite a decent question. Shall we start with Tommy on this? And then Fabio, and then Jonathan at the end, please.
Yeah, so I guess I'll take up, the type of investor here. I would say equity crowdfunding, with B2B fintech, it's, you could obviously still pursue it, but, it's tougher. It tends to be consumer products that do better in crowdfunding because, I guess it's, maybe that's not so true anymore, but a lot of people in crowdfunding space, they like to invest in stuff that they can kind of see, buy, understand. B2B is a bit trickier in that space and tends to be more, you will find angels going via angel networks and other avenues. So you definitely would want to pursue angels, I think, for part of this round, particularly angels that have been successful in the fintech space already, because they will offer a lot of value beyond the capital they invest. So definitely explore angels. It just may not be the crowdfunding is the way to go about that, is to look at the angel networks instead. And when it comes to crowdfunding, there's a lot of work goes into those campaigns. So I think people often underestimate that. You'll be asked on Crowdcube or Seedrs, public as it is now, I think. There's a lot of stuff, a lot of material you need to put together and, pass a lot of checks and things. And then you need to be on top of it, answering questions. So, not that fundraising in itself is any easier, but you know, it'll add a layer to the other fundraising you're doing. So I would say probably that's not your first avenue. In terms of VC or CVC, you know, VC probably is what you want at this stage, I would think. But you know, a combination isn't bad. If you were getting a corporate venture investor at this stage, you know, they can be useful if they can give you access to their customers, and so that could be helpful for building the business. But I think you would still want a VC or certainly some other, you know, more financially motivated investors on the cap table, just so you don't have the corporate venture arm trying to sway too much the business to in a way that would cause you to build it out that's beneficial for them rather than building an actually good standalone business. So you definitely want, you know, somebody on the board, if you have a corporate venture arm involved, that is, you know, pulling for financial returns and not just, you know, aligning to the CVC's goals. So a combination could be really good, actually, if you're able to get both. Obviously it's very tricky. So I think those, you know, a VC and angels and a CVC, if you can get them, is where you want to really focus, and then you really want to get targeted in who you're approaching in those spaces, so making sure they invest in B2B fintech and you're not going to people that, you know, do purely SaaS, don't like payments, or do consumer. So, you know, being more targeted on that. But other than that, I don't think I have a lot to say.
Thank you very much, Tommy. Fabio?
Thanks, Tommy. Yes, some really good points. I think it's interesting. At the beginning, you're in a position where you go, what are the pros and cons? You know, should I go for CVC or VC or both? They have different objectives and different ways of working. I think CVC is quite attractive at first because they can give you customer access, and when you're a startup, you really want to have to acquire customers very quickly. So, and they can bring expertise. You know, they can facilitate some partnerships which can be strategic. You know, you can access some very senior people if it's a fintech, a payment solution, you know, in a bank or a credit card company. I mean, so that's all very attractive when you're a founder and you're starting and you're writing on a blank page. To have this sort of assurance is quite comforting. It can seem faster at the beginning, and you very quickly become part of an ecosystem, and that's all positive when you start. Then you start, you know, understanding what sort of commercial constraints or hurdles you can find. It can be that at some point bureaucracy settles in, and you have to go through different stages to get the final signature, and that can be frustrating. It will be even more frustrating when you want to start marketing to or selling, commercializing to potential competitors of that CVC, and then you find that, you know, there'll be lots of clauses and that will be limiting your ability to actually scale up to the way, or you know, to actually deliver the vision. And that's where VC is probably more suited, where VCs can actually give you access to some commercial partnerships, although it's not their jobs, but that's part of the value add they bring. And that's something you need to assess very quickly, you know, asking the questions. Can you help me as an investor? Can you give me access to those customers or to those corporates? But the end game for VC, you know, it would be to maximize your market valuation, your market value on exit. And that market valuation can be, you know, can have a ceiling with a CVC and not with a VC. And that's going back to your vision, you know, deep down philosophically, what is your vision? What is it that you want to do? Do you want to exit very quickly within a few years to a CVC, and, you know, you won't reach full market value potential? Or it is to actually, you know, conquer the world and have a world domination for your product, in which case a VC is pretty more, or good VC is pretty more suited and with deeper pockets. I think these are the questions at different stages of your startup and of your scaling that you need to ask yourself, and be honest about, you know, can you actually live on a VC vision, which will require, you know, 100x, whereas a CVC potentially not. As soon as the product starts working, you know, they will make an offer. at best, you know, on the other hand, they could do an acquire hire, and you can end up working for the CVC. Is that something you would consider? I mean, it's a long topic, and I've certainly had many conversations with founders about this, but these are pointers so far.
Thank you very much, Fabio. Jonathan, what are your thoughts on this question?
Yeah, I feel like everyone said a lot of the things that I probably would have said as well. I think you just have to have a big self-awareness in terms of what you're building, and really understand kind of like the details of like what every firm you're looking for investment is looking at, and then you know, really have a lot of self-awareness in that, so you pick the best route of growth for yourself.
Well, thank you very much for that, Jonathan. Huge thanks to all three of you. That was, I think, hopefully, well, quite some information for you to consider there. But again, I think for somebody in your situation, it would be best if you can join us live, so that we can perhaps drill a bit deeper into what your situation is, and as the gentlemen have explained, where you want to go. Because I think that would help our panel even more in terms of coming up with the right question for you. Now, one of the listeners here has typed a question in a message to me. So I'll read it out for yourselves. So, if a fintech offers a lot of services and bases all those services in smart contracts, in brackets like client retention, client evaluation, discounts, rewards, and memberships payments, nano influencers, etc., through a digital wallet, keeping in mind that the services are even tailored to SMEs, so that SMEs can later on configure the service that it needs. How do I present the logic of customization to investors without scaring them with all these services? So I'm guessing what the question is here. If I'm offering an array of stuff, I'm scared that I may scare investors who will think I'm trying to do everything. Is there a way to then position this in a more sort of attractive offer? I'll give you my quick 2 pence. Personally, I think you can explain to them, you know, in terms of your product roadmap plans for future editions. But initially, the more you complicate things, the less chances you've got with VCs or any investors. And to be honest with you, in my experience, the less chances you have to get any clients in the first place. So focus on one thing. What is the one thing that you can do better and add most value? And then you can explain that, you know, later on you plan to add whatever else. Let's hear from the gentleman here. So let's hear from Fabio, then Jonathan, and then Tommy on this. Fabio, any thoughts on this?
Just a very quick one. Considering the lack of details and the generic question, don't try and sell a Swiss knife to someone who doesn't even know they need a knife. I think it's pretty simplest way to put it. Just come with a, you know, sell one service really well, something they really need or they didn't know they needed, and from there just expand on the market by providing, you know, upsells and different services. I think this is a rule of thumb really, but again, I don't have any details on the sort of services they're talking about, so that's it for me.
Well, that's a good point. Thank you, Fabio. Jonathan, any thoughts on that? There's a mic icon at the bottom left.
Yes, I know. Yeah, the what's the I think it all boils down to how do you convince yourself, and then you spin that to how do you convince other people. Because first off, you were convinced of this idea and that it works in the first place. So if you whatever mechanism that you use to convince yourself is the mechanism that you're going to use to convince other people. So if you don't even know why you convinced yourself, then you're going to be in deep trouble. But once you know the reason that you convinced yourself, then you just got to try to figure out a way to convince others to believe in the same point of view as you.
Thank you very much, Jonathan. Tommy.
Yeah, sorry, can you just remind me, repeat the question for this one? Is this the prop tech one, or are we on a different question?
No, this is somebody just sent me, they're in the audience, but they sent me a message in private. So he says, if a fintech offers a lot of services and bases all those services in smart contracts like client retention, evaluation, discounts, rewards, membership payments, influencers, etc., through a digital wallet. So this is a digital wallet product, and they want to now sort of offer these services to SMEs who will eventually configure whichever service they use. So they're not, he's aware basically that they're not going to use all those services at once, right? That's part one. Part two is, how can you present this with logic to investors and explain that, you know, we've got all of these things without scaring them and making investors think that, you know, he's trying to do everything but will end up doing nothing. So how can you position that in the sense where you say, look, we're now doing this, but later on we're going to add X, Y, Z, or we have the capacity to add X, Y, Z. How would you do that so that you don't scare the investors off?
Yeah, I think the first thing I'd probably think about doing here is, you know, just some market research actually with, you know, CFOs, finance directors from SMEs, and, you know, good old fashioned cold calling, cold emailing, or if you know anyone, you know, in your network that knows people that, you know, are in the C-suite of SMEs and can connect you with someone, prepare, you know, a questionnaire that you can, you know, speak to them through, walk them through on the phone, or if you prepare Survey Monkey, and just try and figure out, you know, of all the, you know, services you have at the moment, which ones do the SMEs seem most interested in, and that'll kind of guide you on what the biggest problem is and where to focus for that. And then that should hopefully shape a bit better the conversation with investors and be like, I've gone and talked to this number of businesses, this was the most common problem. So, you know, I'd actually just do that kind of work first, and, you know, it'll stop you from making mistakes and focusing on the wrong services or features within the overall product and within the business for SMEs, and, you know, be guided by the market and what they want and let that shape it. You know, it's difficult. Like, you know, we can't sit here, as the others have said, and help you pick and choose. All I can say is, you know, to try and figure out the problem yourself. That would be the way I would go about it.
That's a good point. Thank you very much for that, Tommy. Right, we've got 7 minutes to go. We're here to help startups with whatever questions you may have on fundraising. So if you do have any such questions, we've got a brilliant panel with us today. All you need to do is raise your hand. We'll bring you up on stage. You introduce yourself and then fire away with your question. If there are no live questions, I think we can take one last one, and I've put that in the group chat in the messages. So I don't know if I think Jonathan and Tommy have seen the question. It looks like Fabio may not have read it yet. So if you want to have a look at that, Fabio. So this is quite a mammoth question, unfortunately, but the seed stage prop tech platform for real estate investment in London. And then she goes on to explain, which is quite a long one. Our PropTech platform allows fractional ownership of commercial real estate, a structure that brings in complex EIS, SEIS eligibility concerns due to property investment regulations. Now, my goal is to confirm compliance with EIS requirements despite sector-specific restrictions, ensuring that our startup remains attractive to these angel investors. Now, the question goes on. Our PropTech platform is based on fractional real estate ownership, raising EIS eligibility, challenges due to restriction on property investment and the EIS rules. What structures or investment vehicles can we implement to ensure compliance whilst making the platform tax efficient for UK angel investors? All right. So I can see the comments here in the group. good luck with that. So I guess we are going to need to save that either for when we have an EIS or an SCIS specialist, or when we do our legal Q&A, which will be on the 17th of January. So please do keep an eye on our site and join that one on the 17th of January. I see Tracy. Yeah, go on, Tom.
Sorry, just on this question, like, you know, it is very much a tax and legal question. And in fairness, they've given plenty of information, but the one thing we don't really understand here is the structure of this business. And I did recently have a call with founders of a business, you know, they're kind of more in the home ownership space, so it's not fractional. And I won't go into details, but the way they've structured the business is not like, you know, miles apart from this. So they've got the operating company, which is the platform business, and they're raising capital into that like a, you know, prop tech business normally would. So it's kind of looking for VCs, angels, and that type of structure would be EIS eligible, I would think. So if you're setting it up, and that's not actually owning the property, and then they have another vehicle which is going to like create SPVs and all that other stuff and do the fund management for the actual buying of the properties, and they're raising separately into that vehicle, that's obviously not EIS, SEIS eligible. That's very different. That's a real estate fund. So without knowing more of the structuring, but I would think that you structure this business in a similar way. You would have the operating company, which is the property, the platform, and you're raising venture angel style money into that, and that should, you would think, be EIS eligible. And then, you know, I don't actually know if they're buying the property, because if you're not even buying the property, if it's just a tech platform, I don't understand why they would, you know, and I'm not an expert, so maybe there are issues, but if it's, you know, transacting property, I'm sure there's regulations. But if the business itself is just collecting fees off, you know, managing and facilitating this like a platform, I don't know, but there must be ways to structure that the operating company is EIS eligible, I would have thought. But you know, you really need legal advice here and tax advice, not me that knows very little.
That definitely sounds like that. So I mean, I hope this person does listen to the recording and join us in January, either for our first legal session or our first finance and tax session. Tracy, we've got 3 minutes, so make it a quick one, please.
Yes. Hi, good morning from Houston. Anton, thank you so much for this talk. I actually have a very short question, and the question goes, how do you plan to exit your business? And this is a question to the StartUp founders.
Good question. Thank you very much, Tracy. So what's a good way to plan for an exit? Let's start with Tommy, then Fabio, then Jonathan, please.
Sorry, I just missed the start of your question. It's planning for an exit.
Yeah. What are, do you have any tips when, you know, on how a founder should plan for an exit?
I guess it's a broad stroke question, but I guess you start by thinking what's the type of exit you want, and it depends a lot on, you know, what size of business you have. So is it a business that could be, you know, IPO'd, or is it too small for that? Are you looking really at a trade sale, you know, some M&A activity, and then start to do, you know, some research in the market? Have there been similar businesses that have been bought? Looking at those transactions, looking at if you can find information on the valuations, you know, look at who the buyers are, and I try and do a lot of research and try and familiarize yourself with the market for your business, if you will, and who the likely acquirers would be. And you'll probably know yourself who the likely types of acquirers are. I'd make a long list of that in different buckets of the type of acquirers. So, you know, why they'd wanted, what's the strategic interest. And I do a lot of research yourself and try and use your network as well to ask questions and find out. You know, ultimately you'll probably need to have an advisor come in and, you know, pay them to help with this, particularly if you don't have interested parties coming to you, if they need to put together a sales process. And then what will start to happen is when you work with advisors, they'll start to, you know, prepare you for it. So like, unless somebody is coming and you have suitors trying to buy the business now, if you want to sell it, the process probably will take a while, because you need to, clean up admin stuff in the business. You need to start preparing financials. You need to start thinking about, demonstrating runway in the business, the growth, and, building out all the different, EBITDA tables, things like that. But advisors would guide you through it. But I would start before you go to do a lot of research on who you think the likely buyers are. Try and see if you can understand as much as possible yourself the market for your business out there. And then I'd also do a lot of research on advisors. And I would, if you have a good network of other, founders or people in the world of, banking and investments, if you can, get some warm introductions or advisors that people have used and have good stories of working with, I would do that as well. So you just want to make sure you select the right advisor that is trustworthy, will do a good job, but also knows your sector well and has maybe done transactions in the space.
Thank you very much, Tommy. Fabio, what's your advice on prepping for exits?
Sure. I actually have a hot take. I think you should plan, or you should think of the exit as soon as you start the business. You should have a universe, as we say, a universe of potential buyers eventually. I mean, an exit is either an IPO, meaning you go public, you list your business on the stock market, or you sell to another business. Considering, if you have VC funding, you will need to sell within 3-5 years. You pretty much know your universe of potential buyers, and I think you should build your product. Sign strategic partnerships, potentially appoint advisors to your board, representing this universe. In other words, if you are a game company and you want to sell to Epic Games, or you want to sell to whatever big game company out there, why not having an advisor on your board from those companies? And not saying I will sell you my business one day, but just do like the longest sale of your life, basically, for 3-5 years, demonstrating and showing that they need to acquire your company because it's strategic for them. And if you have this sort of North Star in mind, unless you're on a mission to change the world, and you want to really disrupt the market and so on, then it's another game. But if you want to sell to 3 to 5 businesses out there, start building relationship with them as soon as you start a business.
Thank you very much, Fabio. And last but not least, Jonathan.
Not much to add. Just make sure that everything is done properly, and make sure everything is packaged in such a manner that provides the user value right away.
That's brilliant. Thank you very much, Tracy. In my experience, there are a few reasons why people would buy a startup. Number one is for profit, and that could be investors or others. Number two, it's to shut you down, and that is trade sales, companies that are already in the market and they fear that you will take clients away from them. And number three, it's people that want to have either your staff, i.e. domain, or your IP because you've invented something. These tend to be the sort of top 3 reasons why somebody would buy it. There's also some others, such as companies wanting to go into a new market or a new jurisdiction, i.e. geography, and so on, and a few other sort of smaller reasons. But the top 3 are those. And then you got to start thinking, and pretty much all the guys mentioned this, you got to start thinking, what is your goal? What is your aim here? Once you do that, then you do the research and sort of kind of recognize which of those buyers you want for your business, and just start prepping stuff for that. And I think Jonathan mentioned, just start that relationship early. Hope you found that helpful, Tracy, and best of luck. We are now 4 minutes over the line, so I don't want to keep you gentlemen longer, but if you want to give us any parting words, that's great. If not, I think Fabio and Jonathan, we may not hear from you until 2025. So have a great break and enjoy your end of year holidays. Do you have any parting words for us, gentlemen?
Thank you very much for this year, Anton, and everybody have a good break. It's time to recharge the batteries and planning also for next year. We're all hoping next year will be much better in terms of funding and in terms of innovation. So enjoy the last few days, have a break, because next year will be very busy.
Brilliant stuff. Jonathan?
Not much, but take care and see y'all later.
I just like to say thanks to everyone who sent questions in today, but encourage everyone listening that if you can, join the live sessions and come on. As you see today, you've got good questions, but there's never enough detail in there. We're always trying to make assumptions and stuff, so it's better if you can be here. We can engage with you and speak, and it definitely makes it more interesting for us as well, that we can have a conversation and give more informed answers. Other than that, I don't think I'll be here next week either, so wish you all happy holidays and new year, and speak to you in 2025.
Good stuff. Well, thank you very much to all three of you gentlemen. Really appreciate this. Have a good Christmas and New Year's too. Huge thanks to everyone that tuned in today. We have one more week to go of sessions next week, and then we resume on the 13th of January. We run 4 regular rooms per week: Monday's talent, Tuesday's product and tech, Wednesday's growth, and Thursday's fundraising. They're all from 12 to 1 p.m. UK time. In January, we'll add 2 more sessions, but these will be monthly. Second Friday of every month, we'll do one on legal stuff, and that is UK centric. And the third Friday of the month, we'll do one on finances and accounts and taxes and all that. And that is kind of UK centric, but I guess there will be some universal stuff there as well. If you want to RSVP to any future sessions, you need to go to startuptoscaleup.club. Otherwise, just remember, the startup journey can be both exciting but also quite challenging. So try to have some fun in the meantime and be kind to yourself and everyone else. Thank you again. God bless you all, and have a great rest of the week. See you on Monday for Startup Talent. Bye-bye for now.